Welcome back to Invest with Alex, the podcast where we break down complex investment topics into simple, actionable steps. If you're new here, don't forget to subscribe so you never miss an episode. Today, we're diving into a crucial skill for every investor: how to read stock market charts and understand trends. If you've ever looked at a stock chart and felt overwhelmed by all the lines, numbers, and patterns, this episode is for you. By the end of today's discussion, you'll have the tools to analyze stock price movements, identify trends, and make more informed investment decisions. Let's get started. Stock charts are more than just lines on a graph. They tell the story of a stock's price movements over time and can help investors spot opportunities. Here's why understanding stock charts is important. 1. Visualizing stock performance. Instead of just looking at numbers, you can see how a stock has performed historically. 2. Identifying trends. Charts help investors spot upward or downward trends, making it easier to time entries and exits. 3. Confirming investment decisions. Many investors use charts to validate whether a stock is a good buy or if it's overvalued. Without stock charts, investing can feel like guessing. But once you know how to read them, you'll have a much clearer picture of the market. There are several types of stock charts, and each serves a different purpose. Let's break down the most commonly used ones. 1. Line charts, the simplest type, showing a stock's closing price over time. Great for spotting long-term trends. 2. Bar charts, displays the open, high, low, and close OCHL prices for each period, offering more detail. 3. Candlestick charts, the most popular chart type, showing price movements in a visual format that makes trends and reversals easier to spot. 4. Point and figure charts, less common but useful for filtering out market noise and focusing on significant price movements. Among these, candlestick charts are the go-to for most traders and investors because they provide the most insight at a glance. Now, let's take a deeper look at candlestick charts since they're widely used in technical analysis. Each candlestick represents a set period. This could be 1 day, 1 week, or even 1 hour. A single candlestick consists of: the body represents the opening and closing price. The wicks shadows show the highest and lowest price during the period. Color: a green or white candle means the stock closed higher than it opened, while a red or black candle means it closed lower. By reading candlestick formations, investors can identify patterns that indicate potential price movements. Now that we know how to read a candlestick, let's talk about some common patterns and what they mean. Bullish patterns indicating a possible uptrend. Hammer, a small body with a long lower wick signaling potential reversal from a downtrend. Engulfing pattern, a large green candle fully engulfs the previous red candle, suggesting strong buying pressure. Morning star, a 3-candle pattern that signals the end of a downtrend. Bearish patterns indicating a possible downtrend. Shooting star, a small body with a long upper wick signaling potential price reversal downward. Bearish engulfing, a large red candle fully engulfs the previous green candle, suggesting selling pressure. Evening star, a 3-candle pattern that signals the end of an uptrend. Recognizing these patterns can give investors an edge when deciding when to enter or exit a position. One of the most important skills in stock chart analysis is identifying trends. Here's how to do it. Uptrend, a series of higher highs and higher lows, indicates bullish momentum. Downtrend, a series of lower highs and lower lows, suggests bearish movement. Sideways trend, price moves within a range without clear direction, usually signals consolidation before a breakout. To confirm trends, investors use tools like trend lines, straight lines drawn on charts to visualize the trend direction. Moving averages, averages of past prices to smooth out short-term fluctuations and highlight the overall trend. Volume analysis, looking at trading volume to confirm trend strength. A strong trend usually has higher volume. Technical indicators help traders analyze stock price movements beyond just looking at patterns. Some key indicators include: moving averages, MA, shows the average stock price over a specific time period. The 50-day and 200-day moving averages are commonly used. Relative Strength Index, RSI, measures whether a stock is overbought or oversold. Values above 70 indicate overbought conditions while below 30 suggest oversold levels. MACD moving average convergence divergence helps identify changes in momentum and potential buy-sell signals. Bollinger Bands uses standard deviation to measure volatility. Stocks trading near the upper band may be overbought, while those near the lower band could be oversold. Using these indicators alongside stock charts can provide a more complete picture of price movements and help make better investment decisions. Let's recap what we covered today. Stock charts help investors analyze price movements and trends. The most common chart types are line charts, bar charts, and candlestick charts. Candlestick patterns provide insight into potential price reversals. Identifying trends using trend lines, moving averages, and volume is key to market analysis. Technical indicators like RSI, MACD, and Bollinger Bands help confirm trends and momentum. Now, here are 3 action steps you can take today. Look up a stock chart of your choice and identify whether it's in an uptrend, downtrend, or sideways trend. Practice recognizing candlestick patterns using free charting tools like TradingView or Yahoo Finance. Experiment with basic technical indicators like moving averages and RSI to get a feel for how they work. If you found this episode valuable, make sure to subscribe and leave a comment. What's your biggest challenge when reading stock charts? Let me know. Stay tuned and I'll see you next time.